This morning on BRN, private equity may be in trouble. Where will it go for a bailout? And joining me now to discuss this and a lot more, Eileen Appelbaum is the co-director for the Center for Economic and Policy Research. Eileen, great to see you. Thanks for joining us on the program this morning.
I'm happy to be here.
And I'm really happy to chat with you. We were chatting in the virtual green room, we have covered this issue from a number of different areas. You and your team just came out with a very interesting paper, article, however you want to define it. I thought it was pretty long, so I wouldn't call it an article. It was a white paper. To me, that's like white paper length. But anyway, let's start off with a basic question. What is the state of private equity today? Because I think you guys make some very interesting analysis in that piece.
So private equity is in big trouble. And there are many, many articles in the business press that say exactly the same thing. I'm hardly the only person who has noticed that they have a problem. Their biggest problem is that they are unable to exit the investments that they made. And we're speaking here of the buyout part of private equity, which despite the growth of other segments is still about 80% of what the funds are. And those are the funds that are really interested in finding a solution. So their problem is that back in 2022, when the market crashed, the S&P 500 went down almost 20%. It recovered quickly, so probably you did not even notice that it went down. But meanwhile, it did go down. And it took a while for companies to recover to a price that was similar to what it had been before the crash. Meanwhile, private equity is not required to what they call mark to market. Your stocks are valued every single day. You can see what their share price is. But in the case of private equity, they're valued quarterly, every 3 months. So stock market goes up, stock market goes down, they can ignore it. And at the end of the 3 months, they will tell you what the unsold properties in their portfolio are worth. And I'm here to tell you that those are guesstimates. So they don't have complete latitude, but they have a lot of latitude in how they value the companies in their portfolio. So the market goes down by 20% and the private equity portfolios go down by about 4%. This is not believable to begin with. When the market goes up, they're happy to say, oh, our companies are just like the ones in the market. We'll raise our valuation. But the market went down and they did not follow the market down. The result of that is that they have a lot of properties that they bought at the peak of private equity in 2020 and 2021. And then they did not follow the market down. They ended up with properties that are overvalued. And they are unwilling to drop the price on them and bring them to market and sell them, even taking a loss sometimes just to be able to exit. The importance of being able to exit is that is how you give cash back to your limited partners.
That's right. To your
You
investors.
can have all the paper profits you want, and private equity has tons of on paper they just look fabulous. But since the middle of 2022, and now it's 3 years later, they've returned very little of the money. I'm not saying none. Typically, they return 30% of the asset value is what they have in cash to return to the investors, and now it's about 10%. And
So
it's basically those private equity companies that funds rather that have a company here or a company there that they know is actually valued. They could get what they're asking for, but the most of it they don't bring to market because they know that they will take a haircut on it and that this will be bad for their reputation. So they
yeah,
have no cash to return, and that
yeah.
is their problem.
So what is the prognosis? And past performance is not indicative of future results. I mean, we know that from the mutual fund industry, but longer term. So that is their problem. That is a problem as a result of, as you said, historical maybe underperformance of the market, things not aligning correctly in terms of growing the business. But longer term, and we're going to get into the types of investors in a few minutes, but what does that mean for their investors in terms of their prognosis? Can investors who got in before, during, after recoup some of their money longer term?
Uh, if the private equity funds are willing to admit that the companies they hold are worth less than they said, so that everybody who's an investor has to mark down their portfolio. They will be able to sell them and they will be able to return cash, less than anybody was expecting, but some cash. And what the investors do with that cash is part of it they need. So if you're a pension fund, you have current liabilities. Now, of course, you could sell something in your portfolio to meet that situation. But the whole point of investing in private equity is that you constantly are getting returns, cash returns, which you can then use to meet your pension liabilities without having to sell valuable items in your own portfolio. And if you are an endowment like Yale, you're getting money back that you have committed money for scholarships, for programs, and so on. And again, you can sell the things that are in your portfolio to get the cash to do it, but you've been relying on money back from private equity to meet those demands. And so that's one thing they do with it. And the other thing they do with it is they plow it right back. Private equity's been a good investment for them. They plow it right back into they become partners in new funds. Well, if they don't get the cash back, they are limited in their ability to partner with new funds.
So are some of the, you mentioned Yale, are some of these, and I think I've read, but you would know better than I, are investors, institutional investors, private, as you said, private equity was the darling. Before that, it was hedge funds. Now it seems to be private credit, maybe one of the top flavors of the month. But are more institutional investors kind of pulling their money and saying, I'm going to allocate to a different investment vehicle, a different type of investment?
That is what is happening. And they are taking a haircut on it. So you are Yale, which is one, Brown, Harvard. We have a lot of endowments, CalPERS among the biggest of the, it's actually the biggest public pension fund.
Yep.
All of these they need the cash. And so they are getting rid of their investments. And then there are buyers out there who, if the price is right, they'll buy your stake. So they get your stake at a fair price. And when things are sold, they will get their cash back. But you can't wait for it, and you don't know when that's going to happen. Because the other complicating factor is that in 2022, between 2022 and 2023, the Federal Reserve System, fighting the pandemic inflation, raised interest rates by 5%. So it went from near zero to over 6 in less than a year. And that is really making it very difficult for the private equity guys. They bought these companies when the interest rate was close to zero. Now they're holding them much longer than they ever expected. They need to refinance their debt. And the debt has to be refinanced at 5% or 6%. Actually, they're risky. Probably they're paying closer to 7 or 8%. So private equity is really stuck between a rock and a hard place, as we might say.
Yeah.
It's squeezed on both sides by valuation and by interest rate increases. And these are highly leveraged buyouts. And it's not that private equity per se is a problem, it's the highly leveraged buyouts. So there's a vast private equity industry out there. There are 4,000 funds at the moment. You probably heard of 6 of them or 8 of them.
Yeah, I don't know all of them, but I'm aware of some of the bigger brand
That's
names.
exactly right.
Yeah,
But
they're
there are
not.
4,000 of them out there. So there's a lot of little funds that are just doing business like any corporation would. They do not load the companies they buy up with debt. That is really that's the problem. It's not all of private equity. It's the leveraged buyouts that are the problem. And so we can have plenty of good examples. I wrote a book about this. We were sure to include the good examples. There are plenty of good examples of little companies buying up, little private equity firms buying up little companies, improving their performance, and selling them at a higher price because they're better companies. That's a whole different story. The denominator here is leverage buyouts. And among the leverage buyouts, we're already seeing bankruptcies, meaning the value of those companies is going to go to zero. So if they're in your portfolio, they're not helping very much. So
Yeah,
this is the problem.
it sounds like it is, and you're the expert. I'm not a expert in private equity, but let me ask you, just in a few minutes, we only have a couple minutes left. I want to ask you about, there's been movement that changed the definition of an accredited investor. That would be someone that can invest in these types of products, and also a movement to I'm going to use the word democratize. I think it's completely overused. I use it a lot though. But to give other individuals, retail
Right.
investors, and
Well,
retirement
so
investors the
yes.
opportunity to invest there.
Let's
You
talk.
want to
Let's
talk?
talk about that.
Yeah,
So,
go ahead.
in the first Trump administration, the Department of Labor, which oversees pensions, had a ruling that you could invest in private equity in certain kinds of retirement assets, interval funds. Uh, they defined the funds that you could invest in. Nobody took up this offer. A few for private equity firms developed the product. Nobody wanted it, and they didn't want it because the brokers who advise companies on how to invest their workers' portfolios and the employers themselves were afraid of being sued
Yeah.
because the fees are high, and what if the performance is low? And so it didn't go anywhere. This time around, the Department of Labor, and by the way, the Biden administration did not roll it back. It just added a thing that said you should be cautious, but it did
Okay.
not
Well,
roll
that's
that back.
helpful.
Yeah, it
Past
sounds
performance is
very
not
helpful,
indicative
right?
of future results, right? I mean,
Right,
okay,
right.
that's good. Anyway, I
But
interrupted you. Continue.
looking at today, the Department of Labor is uh, thinking about and likely to provide some liability protection to the brokers and the employers so that you can be unhappy with the performance of your portfolio, but you can't sue them about it. If they acted in good faith, then you have no standing to do anything. So
Hmm.
now they're getting really active. And I should just say what they're after. Uh, Ordinary people, through their employer, have $12.5 trillion of savings. 8.9 trillion of that is in 401ks. And
Yeah,
in addition, people have their own managed retirement, the IRAs, $17 trillion. That's huge.
it
That's
is.
huge.
That's a big country.
Yeah,
That's a big
back in,
GDP of a big country. It's a lot of money.
it's a lot of money,
I can
even for private
understand,
equity.
I can understand the desire
Yep.
to have a product for that market.
Yes, if you're private equity, I can understand that
Yeah, that's what I
desire.
mean. That's what I
Yeah,
mean.
for sure. They want that market. They want liability protection so you can't sue them if it doesn't do well. Back in the first Trump administration, they were talking about 5% of your portfolio should be in private equity. That was before they had all these problems. Now they're talking about 15%. And they claim that they have handled the liquidity problem. I won't go into the details of what they're offering. And they don't have the backing of the Fed or banks or FDIC or any kind of insurance. The backing is that if a lot of people at the same time want to get their money out, that's what liquidity means.
Yep.
Uh, then Apollo will back them up. A very big private equity firm named Apollo will back them up. Well, we saw this movie before. Uh, yes, if it's people who are just taking their money out because they had a medical emergency, that's about 4% of money that comes out each year for people from people take it out of their retirement savings to deal with emergency situations. But if we have a recession in the country, and everybody can see that the value of companies is going down, the part of your portfolio that's in public markets, you could just sell it. The
Yeah.
part of your portfolio that is not, you're going to ask for it back. Apollo will not be able to back a situation like that. We saw that in the subprime market situation. We had a big insurance company, AIG, that said, "Oh, we back." Everybody knew they were not really good things to invest in, but AIG said, "Oh, if they don't work out, we'll back them up," and it just did
Oh, the
not
U.S.
happen.
But not to interrupt, but the U.S. government had to step in and back up AIG.
They had to bail them
Right?
out. That's exactly
That's right.
right.
So you, me,
So
every
So in
taxpayer
this
did.
situation, that would not happen for the following reason. 85% of they only want 15%. So they're going to create a vehicle, they call it, that is 85% public stocks and bonds and 15% buyout funds. If the
Interesting.
buyout funds go under, you still have the 85%. That's the rest of it. You're not your retirement savings are not going to be wiped out. You're just going to get a lot less in the future than you had expected.
Yeah.
Instead of being a boost to your retirement, these investments in private equity have a good chance of being a drain on your retirement income, but you will have lost the ability to sue anybody over that. And in addition, you may not even notice it. You don't know what your retirement would have been without the private equity investments in it. So you got back a 6% return when you should have gotten an 8% return.
Yeah.
No judge is going to say, "Oh, that's a problem." So that's likely.
Yeah. Well, Eileen, I wish we didn't even get into fees. We didn't get into some of the litigation. We're going to have to leave it there. It was so great to talk to you. I think great research. And look, if you're a fiduciary evaluating any investment, whether it's private equity, whether it's public markets, private markets, you got to do your due diligence. You have to understand what you are investing in. You represent as a fiduciary the people that are getting benefits in the plan. That is your sole goal. Very interesting conversation, Eileen. Thanks so much for joining us, and we look forward to having you back again very soon.
Okay, thank you. Bye-bye.
Don't forget to subscribe to our daily newsletter, The Morning Pulse, for all the news in one place. Details, of course, at our website, and your subscription helps support all this great BRN content. We're back again tomorrow for another edition of BRN. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.